You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. This is your host, Jennings Smith. Would you buy this deal? A 280 unit that was 75% vacant. We're talking hemorrhaging cash. We are talking major loans, bridge debt, heavily distressed, and run into the ground. This place, you talk 75% vacant. So out of 280 units, there's only 60 or 70 that are occupied with 200 vacancies. These are the kind of deals that are very scary, somewhat dangerous. But what if you could do it with only 1.5 million in cash into the deal, right? Including renovations, including carrying costs, including your down payment. What if you could jump into a deal of that size for 1.5 million down? Then would you maybe do it? What if the potential upside on the deal was $10 million, right? You could be all in for 18 to 19 million and sell it for 28 to 29 million a year and a half to 2 years later. Now, would you take a shot on this deal? Well, this was a deal that was presented to me, and it was pretty scary. I got to admit, when looking at it, I was thinking, wow, this is heavily distressed, but given the right circumstances, I might be interested. And so today is November 29th. If you're listening to this, it's probably not November 29th, but today is my birthday. And so for my birthday, I'm going to give you a present. I'm going to take back the veil. I'm going to dig into this deal, which we actually did do. We closed it earlier this month. And I'm going to give you the details on what we paid, how we structured it, what we're going to do, what the plan is, how we mitigated the risk, because this deal is actually going to turn out to be a pretty great deal, knock on wood. You know, we hope that this thing is going to be very, very profitable for the team, and I want you to know the details about it. And I'm also going to show you how you could get involved in a deal like this, how I got involved, because I didn't find this deal. I didn't get the loan. I'm not even operating the deal. I'm not doing all the renovations. However, I am involved in the deal. And so I wanted to show you how I got involved and how you could get involved in a deal just like this by bringing value to a deal. Okay, so let's get into it. 280 units in Columbia, South Carolina. I live in Charleston, about 90 minutes from Columbia. And this deal had been bought back in 2019 by a large multifamily group that pretty much only did Class A properties. They bought Class A, they bought in their market, and as they grew and expanded, they decided to step into this Class C asset, and it's in a B area. It's not a bad area, and it's really not a bad asset, built in the 80s, and they picked this thing up for, I'm not exactly sure how much, probably low 20s million, big deal, and they put $16.7 million worth of debt on the deal. Okay, so they bought this property. They hired a large third-party management company. I think it was a national company, and they were going along okay until spring of 2020. And if you remember what spring of 2020 was, that was the advent of, the pandemic, right? So the pandemic came in, and the pandemic hit all apartment people. And I was very nervous about the pandemic. We were hearing news headlines of eviction moratoriums. Everyone was going to be staying at home. Everyone was going to lose their job. Everyone was going to not pay their rent. Apartment owners were going to go belly up in droves. And of course, that did not turn out to be the case, mainly because the government stepped in and helped, right? They started to drop a lot of COVID relief money. I think they gave everybody $7,000 or $8,000. And they had a lot of assistance programs where if you couldn't pay your rent, you could get assistance from the government to pay your rent. And so what we found was, as we got on top of that and we researched these programs and we helped our tenants to get aligned with these programs, we found that our collections did not suffer during COVID, and we actually did fine. We actually did even a little bit better than we had been doing before. And so we got through this. However, this operation did not capitalize on this. Their tenants stopped paying. They didn't communicate with the tenants, I guess. They didn't get them set up with these programs. And then as the tenants stopped paying, they could not evict them. And then Bad got to worse. They started leaving in droves. They started boarding up units. They didn't have the money to continue operations. And so this thing quickly became kind of a spiraling death hole for this company. And so then on top of that, to add insult to injury, their management company went bankrupt. So all the properties they've been managing overnight, they kind of just disappeared, went bankrupt, gave up on the property. And so now there's this company's trying to manage it in-house, hire people, struggle along without many systems and processes because that's not really what they do. And this is how you fast forward to 2023, they get into the situation that they're in. And now the bank is knocking, right? The bank is knocking at the door. What's going on with this property? Why is the vacancy so high? You're 3-4 months behind on your payments. You're not escrowing your taxes. You're not escrowing your insurance. We are going to foreclose on this loan, which is really worst case scenario, not only for the investors and the group that owned it, it's also kind of a bad scenario for the bank because when they do that, it goes into receivership. It takes a year or two to process all of that. The whole time, the property is probably getting vandalized. It's definitely not making any money. It's falling into disrepair. And so it's a situation that banks don't want to be in. It's definitely a situation that investors don't want to be in, but that's what they were faced with. So one of my colleagues, the guy's name is Carlos, he came across this deal through a property manager connection. This property manager had heard about this property and had told him, hey, this group is in trouble. You may want to talk to them about working with them. Maybe you can salvage something. I mean, there's definitely a value add to be had here. And not only was this 280 unit underwater, they also had a 300 unit that was about 7 minutes away that was in the same scenario. So they have almost 600 units heavily distressed, and they need help. So Carlos ended up taking down the 300 unit. I was not involved in that, but he came to me on this 280 and said, hey, I want to make a run at this deal. Would you be interested in working with me? Because we've exhausted a lot of our cash and investor base in the first deal, and we're going to need help on the second deal. So I looked at it and I wasn't real happy with it, but once I dug into the details of the deal, I got a lot more comfortable because I was looking at investing my own cash into this deal. I was also looking at investing my investor base into this deal, and I want to steer them correctly. I want to put them in something that's going to work and make them money and be a success for everybody involved. And so I look at these deals pretty carefully and very closely. And it's because it's pretty painful when they don't go the way that you want them to go and you miss on deadlines. And there's other podcast episodes about that. If you want to listen to a $6.1 million deal gone wrong, I think last episode I talked about the reason I'm selling some of my properties in a down economy, largely to get investors their capital back and live to fight another day. So we take it very seriously. It's got to be the right deal. It's got to be a good deal to get me involved in that. But here's what I liked about it. The problem was mostly vacancy. The group had dumped, I think, $2 to $3 million into rehab. In fact, they had 90 units that were already fully remodeled and boarded up. Right, we unboarded some of them. I went and walked the property with Carlos. We unboarded some of the units, and he walked all of them. But I walked a few of them, and they were like done. New floors, new paint, new cabinets, new countertops. And I don't mean rehabbed a few years ago. I mean brand new with stickers on them, new appliances, 90 units like that. The other 90 units had been rehabbed within the last 5 to 7 years, so they really weren't bad. And then, the other ones were occupied. And so the problem wasn't going to be a huge renovation and construction nightmare. Renovation and construction brings a lot of risk, right? Is it going to go over budget? Is it going to go over the timeline? Are we going to run into unforeseen problems? That wasn't really the case on this deal. It was more about the lease up, like marketing, getting tenants to move in, onboarding, cleaning these units out, making the property presentable. And so if we can go from 60, 70 units occupied up to 150 units occupied and get to 50, 60% occupancy pretty quickly because these units are ready to go, well, that's going to bump the cash flow a whole lot and make this deal start carrying its own weight pretty quickly. So that was a really a good thing that I liked about the deal. Second thing I liked about the deal was Even though this property was distressed, it was still 280 units, mostly, 2 bedrooms, few ones, few threes, mostly 2 bedrooms in a Columbia market where you could easily get $1,000 to $1,200 a month in rent for a 2 bedroom. And so even though the occupancy was a problem, there's definitely groups out there that would pick this thing up for 17, 18, 19 million dollars. Now, stabilized to be worth 28 to 30 million, but distressed, they're still willing to pick it up at that price. And the loan on it was only 16.7. What we needed to do was come in with about $1.5 million in cash. This would be to get the units back online, to get the back taxes paid, get the bank happy again, get carrying costs in the bank so we can make the turn over the next year and a half. And so the cash in the deal for the size of the deal that it was really was not a huge significant amount. And so I liked that. I liked that the leverage on the deal wasn't crazy. So worst case scenario, we could probably take this to, an auction and still get 19 million for it. So I felt fairly insulated that we weren't going to get upside down where the property wasn't even worth the loan amount. The next thing I really liked about it was the money that we put in via me and my investors was right in second position behind the primary loan. So we were able to rewrite the operating agreement with the existing company, and we move into the capital stack in front of their investors. Okay. So the way the deal worked was the original group stayed in the deal. They stayed on the loan. We did not sign the debt. They're still on the debt. They moved their investors up the capital stack, right? So they're getting paid after we do. And we moved into the capital stack right behind the bank. So when this thing sells, the first 16.7 million goes to the bank. The second $1.5 million goes back to us to pay us back. The next tranche of money, which I'm going to get into, goes to us, right, as our preferred return on the capital that we put in. And then it goes to a split between Carlos and the GPs and this other group that is a partial owner now. So I liked that we're not coming in behind their original down payment, behind their renovation dollars, like we're in front of them. So it's a power move to get right there behind the bank on the capital stack. So let me just break down the full structure. So the returns for the investors were very, very good. Because of the level of distress of the deal, we offered a 50% fixed return on the money. So if you invested $100,000 into this deal at the liquidation event, right, whether that be a refinance or a sale, within 2 years, you got back $150,000. You got roughly 25% per year. So it was a 50% fixed return. If it goes faster than 2 years, you still get the 50%. If it goes beyond the 2 years, they get the 50% plus a 1% penalty for every month that it goes beyond the 2 years. So our group is incentivized to get this thing done, get it done quick, get the investors' money back out, and sell the property. So that preferred return is also in second position to the bank, right? Right behind the bank, but ahead of all of the other profit sharing of the whole deal. So that was very attractive. And then the last piece of the pie was anything beyond the capital we injected in the preferred return was split between Carlos and the GPs and the original group, 65-35. Carlos 35, them 65. That way they can recoup, some of their investors' money, hopefully all their investors' money, and the GP team can make a good 35% of the profit on that after they made 50% on their money. So it was a really strong return for us coming in and taking on a project of this magnitude. And the last reason that really gave me the confidence to be a part of this and put investor money in this deal was the track record. So Carlos and Nate, his partner, have done this in Colombia. This is what they do. This is their bread and butter. They buy distressed assets in Colombia, in that area. They fix them up and they flip them and they sell them. And they had already done this on the 300 unit 7 minutes down the road. They bought that 8 months prior and taken it from 25% occupancy to over 60% occupancy, which on a 300 unit is no small feat, within 8 months of getting into the deal. And so I knew that he has the crews. He's got 14 people on site now on both properties, 14 people on each site doing these renovations all day, every day. He is the management company. He is the contractor. He is on site 3 times, 4 times a week, eye on the ball. And I saw what he had done on the 300 unit. And it's just a rinse and repeat deal on this one. I'd seen the rental demand. I'd seen the leases that they were getting. I'd seen the lease pricing that they're getting $1,200, $1,300, $1,400 a month for 2 and 3 bedrooms right down the road. Similar asset, similar product. I felt confident that they were going to be able to get that here. And as we've moved into the deal, we have been able to get those rental rates, which is above our pro forma. So our pro forma was $1,000 a month. Filled it up to 90%, sell it for $100,000 a unit. That's what our pro forma is. Hopefully we can exceed that. But even if we don't exceed that, even if we don't hit that, right? Even if we only sell for 22 million, 23 million, my investors are made whole. They've made their return, and the profit split is not as great to the GP team, but that's okay. My investors made their money. They got what they were promised. And so those factors of a solid, debt, right? With a bank that's willing to work with us, that's extending the loan, giving us time to do it, being in second position on the capital stack, the low-hanging fruit of the renovations being mostly done, and the track record of the operator, which is probably the most important piece of this puzzle, that he's already in this market. He's already flipping apartments in this market, been doing it for 7 years now in this market, and did a sister property 8 months ago with the same exact problem with the same group. This gave me the strength and confidence to be like, this is going to work. And so this is how the deal happened. And now, how did I get involved, and what does this have to do with you? So they had a problem, right? They had done a large lift fairly recently, and their investor base was exhausted, right? They had already plowed $2 million into this prior deal of their own cash and their investor base. And so they needed help on this. So they asked me if I could help them bring $1 million of the $1.5 million to the table. And after looking it over, thinking over, praying it over, seeing the property, seeing the sister property, I did agree to help them with that. And so because I had the skills to be able to deliver on that, and guys, I'll tell you, even with my level of expertise and reach, it was still difficult to get that in because of the environment we're in right now. People are scared. They're nervous about multifamily. They're nervous about the economy. They're nervous about the Fed and the interest rates and on and on and on. However, we stuck with it. We stuck with it. We made the calls. We went to our well. We went to our investor list. We got a lot of no's, but we got some yeses. And then we got some more no's. And then we got another yes. And then we got another no's. And then we had people flake out. And then we had one guy come in for a large chunk at the very end, wiped out the rest of the raise, and got this thing across the finish line. And what this has to do with you is being prepared. Opportunity will meet preparation. And when opportunity meets preparation, that's where returns can be generated. And so when I say preparation, I don't just mean I had a Rolodex full of people that I could call. It meant I had put in the work, right? I had put in the work of knowing this is a good deal. I'd put in the work of knowing this is a good deal structure. I put in the work of building a relationship with Carlos. I'd actually already done a deal with Carlos. And so I had the confidence that he could perform with this. I was able to put together a pitch deck, right? That was a compelling pitch deck that told the story. I was able to jump on the phone with multiple investors, tell the story of the deal, and get people to buy into our vision, into our vision of what we're doing. And so when all this preparation came to the opportunity of Carlos and being involved in a potential $10 million profit, I was able to interject myself into that deal because I'm bringing something that they really, really needed. I was bringing a really big piece of value, $1 million wired into their operating account so that they could take this deal down and go forward with that. And so my challenge to you is, we're in separation season. You may have been seeing this on social media, but December is the time to kick back. It's the time to relax. It's the time to, hey, we're not doing anything until January. Well, if you're in that position, fine, great. But if you're not, if you have not built the life that you want to build, if you have not unlocked your life to the capacity that you want it to be, this isn't the time to take a month off. This isn't the time to just, nobody's going to be doing anything. Yes, people are. People are now, they're going to parties. They're hanging out. They're in a cheerful mood, right? They've seen how they've done this year. Hopefully they've done well. Some people definitely have done well, and they're looking for tax advantage. They're getting whacked on taxes. They're looking for places to place capital. They're looking for solid opportunities and solid deals. And if you are building and investing in the skills of knowing how to do this stuff and talking with investors and building that investor base, this is where that preparation can meet the opportunity so that you can get involved in something like this. And this may seem like a lot, but there's a lot of deals out there where somebody needs $200,000 or $300,000. 2 or 3 people can put together $200,000 or $300,000 pretty quickly. There are people that, they're raising $1 million, $2 million, and they need one other guy to come in for $500K. They need boots on the ground. They need somebody to help them partner up. They need somebody to lead the construction. They need somebody to be a part of the team. And this is what we do in the deal room, is put these partnerships together, help people create value in themselves so that they're prepared for that opportunity, because opportunity is coming by. And if you miss it, well, there's another bus coming down the road. But if you're never prepared, you're always going to miss the opportunity. You're never going to see it, and you're never going to have the confidence to take those first steps. So if you want to take a few first steps, shoot me a DM. I got a underwriting course I can send you, no cost. I've got my spreadsheet I can show you with videos on how to use it. If you already have some rental property and you want to move into multifamily and you want to build these skills, we can talk about the deal room. The deal room is, pretty reasonable. It's $400 a month to be in there, and there's no contract associated with it. So if this is something that you're moving towards, how do I raise capital? How do I find off-market deals? How do I structure this stuff? And you want advice, mentoring, a network, a group of people that can help you get this dream across the finish line, well, then that's what the deal room is for. All right, guys, well, it's my birthday, so I got family coming over. I'm going to pop on downstairs and get on with the birthday celebrations, but I wanted to take some time to hang out with you guys today and appreciate you listening. If the podcast has helped you in any way, shoot me a message. I read them all and I respond to them. Take some time this week to unlock your life. Peace.
This is thepodcastfactory.com.